Good morning, venture capital. This is Metagame, and today we're inside China's biggest Q1 in years, and the number that doesn't add up. So China's 16.5 billion. Where did it go? StepFun, foundation models, Moonshot AI, agentic systems, Galaxy Bot, AI robotics. 3 frontier AI labs absorbed the dominant share of China's capital in Q1. Not consumer internet, not fintech, not SaaS. Frontier AI infrastructure, the same sector capturing the overwhelming majority of capital on the US side of the Pacific. And here's the part that tells you everything about how Beijing views these companies. Chinese regulators moved this quarter to require explicit approval before Moonshot AI and StepFun could accept US origin capital. When a government draws a regulatory perimeter around specific companies, it's not protecting investors. It's protecting assets, national assets. Let me break this down directly because the framing matters. The word venture implies a certain set of assumptions: financial return logic, governance rights, exit liquidity, competitive deal dynamics. What's happening in China's frontier AI market right now violates most of those assumptions. When the anchor of a megaround is a state-affiliated fund operating on strategic positioning logic rather than IRR models, the round isn't priced by a cap table. It's priced by national interest. That's not a criticism. It's a structural description. And if you're underwriting these deals with conventional venture frameworks, you're using the wrong instrument. Which brings us to DeepSeek. The information reported one day before this episode's research locked that DeepSeek closed a funding round north of $7 billion. The governance terms restricted new investors' voting rights. China's National Chip Sector Fund, the Big Fund, was in talks to anchor the deal at a reported valuation of $45 billion. $7 billion raised, $45 billion valuation, restricted voting rights, state fund at the anchor. That is not venture capital. That is infrastructure finance with a cap table. And it is the sharpest single data point yet for what Q1's numbers were already telling us. Now here's the parallel that should be making institutional allocators sit up straight. In the US this quarter, 41 deals of $1 billion or more absorbed $193 billion, 76% of SEC reported capital. The top 4 companies, OpenAI, Anthropic, xAI, Waymo, captured 65% of $300 billion in global venture. The average mega deal size was $4.7 billion. 4 companies, 65% of the global total. On the China side, 3 labs. Dominant share of $16.5 billion. The mechanism is identical on both sides of the Pacific. Capital is collapsing upward into a small number of strategic positions. This is not a US story. It is not a China story. It is the only story in Q1 2026, and it's operating simultaneously in both the world's largest venture markets. The bipolar AI world doesn't need a prediction. It's in the Q1 data. So what does this mean if you're allocating? The thesis question has changed. Geographic diversification into Asia used to mean building a portfolio that captured a range of emerging market dynamics: consumer growth, digital payments, supply chain, modernization. The Q1 data says that playbook is not where the alpha is concentrating. The alpha in China is now in one sector, and within that sector, in a handful of companies. The question isn't, do we have Asia exposure? The question is, do you have access to the 3 to 5 Chinese frontier AI labs that will absorb the next $50 billion? And access is the word that matters, because access is exactly what's getting restricted. US origin capital now requires regulatory approval to enter Moonshot AI and StepFun. Cross-border M&A, your most reliable exit pathway for a decade, is under structural pressure. The Manus deal block earlier this year added the exit dimension to a story that was already complicated on the entry side. If you gain access to one of these companies, you may be holding equity with limited information rights, limited governance, and limited exit liquidity until a domestic Chinese listing materializes. That is a different asset class than venture. It has different risk parameters, different return timelines, and different underwriting logic. Here's the flip side, and this is where it gets genuinely interesting. If US origin capital is being restricted from the top tier, the competitive set for those rounds narrows. Domestic Chinese capital, sovereign adjacent funds, regional LPs with regulatory clearance, they're competing against fewer players for the same allocation. When the field narrows, the access premium expands. For any allocator with a structurally clean path into those syndicates, the scarcity of competition may be as valuable as the underlying asset. The restriction isn't just a risk. For the right counterparty, it's a moat. But let's be clear about what this requires. It requires being on the right side of the regulatory perimeter. It requires governance frameworks built for strategic assets, not conventional venture positions. It requires exit modeling that doesn't depend on cross-border M&A. And it requires being honest with your LPs about what kind of exposure they're actually getting, because China AI venture and quasi-sovereign strategic position in a national AI champion are not the same sentence. Now close the loop. We opened with 60%, 16.5 billion into 3 laps. Not a recovery. So what is it? It's a concentration event. China didn't reopen, it consolidated. The capital didn't disperse across a recovering market, it collapsed into a national championship bracket. 3 frontier AI labs, sovereign adjacent financing, regulatory perimeters that tell you exactly how Beijing categorizes these assets. The Q1 data established the pattern. The DeepSeek round, reported the day before this episode locked, is the exclamation point. The US has 4 AI national champions. China has 3. 2 frontier AI capital markets are forming, each concentrating into a small number of strategic positions, each operating with financing structures that look less like venture and more like infrastructure finance. The question was never whether this was happening. The Q1 data confirmed it's already happened. The question, the only question that matters for your portfolio, is which side of which pole you're actually on. Not which side you think you're on. Not which side your last fund deck said you were on. Which side the data says you're on. Because in a world where 65% of global venture goes to 4 US companies and most of China's 16.5 billion goes to 3 labs, being adjacent to concentration isn't the same as being in it, and in this market, adjacent doesn't pay. That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.